Several of the world's largest economies are currently in recession, and it raises a critical question. Could 2024 be worse than 2008? To explore this, let's break it down into 3 key steps. First, we need to examine the global recession we're either entering or have already entered. Then, we'll look at the interconnectedness of global banking systems and how they might exacerbate this situation. Finally, we'll consider the differences between now and 2008, and whether they signal that the current economic outlook could be even more precarious. Step 1. The global recession and economic interdependence. The global economy is undeniably interconnected. The United States, the UK, Germany, China, and Japan are major players that shape the world's economic landscape. Presently, Germany is in a recession, and the entire Eurozone seems to be on the same path. Meanwhile, China is grappling with deflation, the worst it's seen in decades. While China has not officially declared a recession, it's hard to imagine how an economy can undergo multiple quarters of deflation and avoid eventual economic contraction. Japan and the UK are also experiencing recessions. However, despite these global slowdowns, the US economy seems to be thriving. Unemployment is at historic lows and the stock market is performing exceptionally well. But how is this possible when many of our major trade partners are struggling? To understand this, we have to look at global trade dynamics. The 4 largest economies for manufacturing are China, accounting for 28% of global output, the US, 16%, Japan, 7%, and Germany, 5%. These countries are deeply intertwined, relying on one another for imports and exports. For instance, China exports goods to Japan, Japan exports goods to China, and both countries engage in similar trade with the US and Germany. When one economy stumbles, it sends ripples through the entire global network. Let's take the US as an example. While we produce less than we consume, we still export a significant amount of goods, especially to nations like China and Germany. When these countries face recessions, their demand for US exports decreases. In theory, one might think that if exports slow, we could simply consume those surplus goods domestically. But that's not how it works. Take poultry and corn, 2 major American exports. The US already consumes vast amounts of these products, and it's unlikely that domestic demand could increase significantly enough to offset the loss of international buyers. So if Chinese consumers stop purchasing American poultry, prices would likely drop, which would then lower nominal GDP. The other side of the coin is that while the US exports a lot, we import even more. With global economic activity slowing, many of the companies producing goods we consume are likely to go under. This would result in fewer goods being available for US consumers, driving up prices, and more importantly, slowing economic activity. An interesting parallel can be drawn with Japan. Their stock market, like the US, is at all-time highs, and their unemployment rate is below 3%. Yet, Japan is officially in a recession. The same holds true for Germany and the UK. Their stock markets are also performing well. Unemployment remains low, but they are all officially in recessions. This goes to show that stock market performance and low unemployment alone cannot prevent an economic slowdown. The US might not be far behind. Step 2. The banking system's role in a potential crisis. We know the global economy is interconnected, but banks are arguably even more so. The global financial system has no borders when it comes to interconnectedness. Chinese banks, German banks, Japanese banks, and US banks all operate within the same vast network. This brings us to a crucial point. Remember the global financial crisis, GFC, of 2008. The G in GFC stands for global, because the crisis didn't just impact the US, it caused ripples across the world. The 2008 crisis began with the real estate market crash in the US, which then spread to banks in the UK, Germany, China, Japan, and beyond. This wasn't just a US issue. It became a global financial crisis because of how interconnected the banking system had become. A collapse in one major economy's banking system inevitably affects others. Fast forward to today, and the dynamics within the global monetary system are even more extreme than in 2008. banks are now more vulnerable to systemic shocks because of their interconnectedness and reliance on the same monetary networks. If we are heading into a global recession, the risk to these banks increases, which would in turn increase demand for safe assets like U.S. Treasuries. In the past, when faced with a recession, central banks like the Federal Reserve in the U.S. responded by lowering interest rates. But now, they have a new tool in their arsenal: quantitative easing, QE. Since 2008, central banks have relied on QE to stimulate the economy by buying government bonds and other assets to increase liquidity. In 2008, the Fed's balance sheet was around $40 billion. Today, it's closer to $3.5 trillion. This means the Fed has already injected massive amounts of money into the economy. If another crisis hits, the Fed will almost certainly resort to QE again. But here's the catch. When the Fed engages in QE, it removes treasuries from the open market, which is problematic because treasuries are the bedrock of the global financial system. Banks worldwide rely on them as collateral for various transactions. So, by pulling these treasuries off the market, the Fed might inadvertently make it harder for banks to access the collateral they need, increasing risk in the system. This process is known as the siloing of collateral, a term coined by IMF expert Manmohan Singh. Essentially, while QE helps individual banks that have access to the Fed's balance sheet, it harms the system as a whole because it removes vital collateral from circulation. This could make a recession worse because it increases the vulnerability of the global financial system. Step 3. How 2024 differs from 2008. To determine if 2024 could be worse than 2008, we need to ask ourselves, what's different now? One of the most important differences is the role that U.S. Treasuries play in the global monetary system. Today, they are not just important, they are indispensable. Treasuries function like oil in an engine. Without them, the system seizes up. In 2008, central banks did not rely as heavily on QE or similar monetary tools. Back then, the Fed responded to recessions primarily by cutting interest rates. But now QE has become the go-to move, and its widespread use has created new risks. Consider this. If the Fed launches QE during the next crisis, it could take an enormous amount of treasuries off the market, just when the banking system needs them the most. This would increase instability across the global financial network. While QE helps by injecting liquidity into the market, it also removes a key asset that banks depend on, potentially creating more problems than it solves. Moreover, we're seeing a pattern emerge. Each time there's a crisis, whether it's the dot-com bust in the early 2000s, the GFC in 2008, or the COVID-19 pandemic, central banks have to do more and more to keep the economy afloat. The Fed's response to COVID dwarfed their response to 2008, with trillions of dollars pumped into the economy through the CARES Act and other measures. If a crisis hits in 2024, the Fed and the government might resort to even larger fiscal responses, perhaps an $8 trillion stimulus package. But there's a catch. While these massive interventions may prevent a complete collapse, they also widen the wealth gap. Central planners know that in order to keep the economy going, they need to prop up asset prices. But in doing so, they exacerbate problems like homelessness, drug abuse, and reduced purchasing power for the average American. The more they intervene, the more fragile the system becomes. It's important to note that the U.S. economy is far more dependent on asset prices now than it was in 2008. If the stock market were to crash by 50%, the consequences would be far more severe today than they were during the GFC. In contrast, in some countries like Colombia, a 50% stock market crash wouldn't even make the front page because so few people own stocks. But in the U.S., a major market crash would lead to a global economic meltdown, reflecting the fragility of the system. Even though central planners will likely respond with aggressive measures like QE and fiscal stimulus, these interventions come with diminishing returns. Each crisis requires more intervention, but each time the effects are less potent. The current state of the U.S. economy, with its massive asset bubbles, widening wealth gap, and rising cost of living, signals that the next crisis, whenever it occurs, could be even more catastrophic than 2008. In summary, while no one can predict the future with certainty, all signs point to the fact that the risks in the global economic and financial systems are greater today than they were in 2008. The probability of a worse crisis is higher, given the fragility of the global economy, the interconnectedness of our financial systems, and the increasing reliance on monetary tools that might do more harm than good in the long run.